Let's talk about how the world's changed in the last year since the last time we did one of these webinars. Interest rates have gone up 4%-ish in the last year plus. What does that mean for the debt fund?
Yeah, it's a wonderful question. So on our debt funds, we're in short, half of our money in the fund is investors' money. The investors coming in, as I described, generating a double-digit return with 90-day liquidity. And about half of our money comes in from leverage, from mainly regional banks. And so as you just mentioned, the rates that we're paying for the debt we're borrowing have gone up about 4%. As I showed in one of the past slides, our returns to investors have stayed about flat. And that's been, a call by design. So what our focus has been on using this opportunity to find the highest quality sponsors, mainly continue to lend to the highest quality sponsors we already were lending to, be able to increase our rates to them while keeping leverage down to be able to keep our returns at double digits. So in effect, we've been able to increase our rates by about 2% that we're charging borrowers while only lending to our highest quality borrowers while lowering our leverage 5 to 10%. So we've reduced risk, increased quality of borrower, and kept returns about flat, despite the fact that our cost of leverage on half of our capital has gone up by about 4%. And that's been our focus. We could have taken more risk and lent to lower quality borrowers, lent at higher leverage points, and increased returns. But our focus is on hitting our mandate. And our mandate is to hit over 9% returns net to investors. And we've been able to do that, stay over 10% while mitigating risk. And that's why we've had to date, we've never written off $1 of interest on any loan we've ever written, over 4,000 loans. Haven't written off $1 of principal, and have actually had delinquency decrease over the past year despite the volatility.
What does that mean for them? I mean, is there less demand for loans from the debt fund than there was a year or two ago? Or is there increased demand because you've only increased rates 2% while general interest rates have gone up 4%? How's that affect the operation of the fund?
So realistically today, and I probably couldn't have said this a year ago or 2 years ago, but today, if I had twice the capital, I could write twice as many loans without any decrease in quality today. So the demand has never been higher, and the demand's never been higher for a few reasons. One big one is the borrowers we lend to are bankable borrowers. They can go to banks, they can go to agency, they can get the best financing out there. The reason they borrow from us is a couple reasons. One is surety of execution, 2 is speed, and 3 is reduction in, I'll call, friction costs. And so, a year ago, they may have been able to go to a traditional bank and borrow at 3.5%, and we were 9.5%. Right? That's a pretty big gap. And some of the best borrowers would say, all right, it's worth dealing with the pain to work with a bank when it was 3.5 and DLP was 9.5. Well, now that bank is 7.5 or 8.5, and DLP is 11.5 or 11, the gap has closed. So they'd rather borrow from us and pay a little bit higher for the short-term nature of our type of lending. That's one reason. But the bigger reason is in this market is most lenders don't have liquidity today. Liquidity is a major challenge. So many lenders right now are struggling because they wrote a lot of loans, locked in low interest rate loans for 5 years, 10 years, 20, 30 years, and are struggling with liquidity that a lot of lenders, both banks as well as other private lenders, don't have access to capital today. So the demand for our capital, has never been higher, as so many of the other sources out there just are out of the market today. So we're in a really, really great position that we can really choose who we want to lend to. We built deep relationships with people who know us and trust us. And we can lend, again, we've lowered our leverage 5-10%, and it hasn't deterred any business away. So we're in a really great position today.
The hosts of the YQA Investor Podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.